Hi Nixon Nation, my name is Eric Martineau and this is my wife Diane. We are both loan officers with Nexa Mortgage, but we also have our licenses with the insurance team. Today I want to talk to you about private equity banking, probably one of the most powerful financial tools available to us today. The reason I'm here today is because last December, Mike Cordes in one of our town hall meetings said he and Matt were looking for a better solution to the 401k that the company currently had. So I sent Mike an email and I said, hey Mike, private equity banking is better than any 401k because one, it provides benefits a 401k can't, like guaranteed returns, tax-free growth, no age restrictions, and no market volatility. So we bounced a couple emails back and forth, and finally, when it became evident that private equity banking is done inside of the wrapper of a whole life insurance policy, Mike wrote me the following, and he said, the big problem I see here is whole life. I'm not a big fan of it at all. I'll look into it, but whole life is not a tool that I am a big fan of. Okay, so I sent him back another one and I said, you know what, Mike, I hate typical whole life insurance too, but with all due respect, this is not a typical whole life insurance policy. I then told him that I had attached a video that I had made about how to 3x your real estate holdings, 3x the profits on your real estate holdings using private equity banking. I told him these are real examples and real numbers, and would he please watch it? So he watched it. He wrote back about an hour later and said, okay, I'm very interested. So what you're doing here is you're creating the idea of a bank, right? And I said, yes, Mike, that's exactly it. That is why the New York Times calls private equity banking the secret of the affluent. Because what you do is you learn how to become your own bank for your own family and or business. And so that's what I'm here to talk to you about today is private equity banking and how it is done. So there's going to be 4 parts to this presentation. The first one is about cash value accumulation contracts and what those are. This is a term that the IRS uses to distinguish how a private equity bank is different than other banks. The next section is I'm going to explain why the New York Times actually called private equity banking the secret of the affluent and the benefits that you can obtain from them. And then in the third section, I'm going to give you some simple strategies on how you and or your clients can use private equity banking to improve their financial standing, or better yet, create and maintain generational wealth. And then finally, I'm going to give you some real live examples. These are people that I've worked with. I'm not going to show you their names, obviously, but I'm going to show you accumulation contracts that I have helped create and that are helping others. And they should give us a broad idea of how this all works. What is private equity banking? And I'm going to use a third party to basically explain it. Ed Slott is one of America's most renowned tax experts. And he did a presentation called Retire Safe and Secure. And in that presentation, he talks about how we as Americans can take our money from forever taxed buckets of money to never taxed buckets of money and protect them from taxes, market risk, and longevity risk. So what is private equity banking? According to the IRS code, these contracts are called cash value accumulation contracts. That's the term the IRS uses when dealing with private equity banking. Now, an accumulation contract has to be written by a legal reserve insurance company, all right? It can't just be a bank or anybody else. It has to come from a legal reserve insurance company. So before we go much further, let me define what Ed Slott was talking about between forever taxed buckets and never taxed buckets. In the forever taxed buckets, we have our income and our dividends, right? We make a salary, we pay taxes. That one's easy to understand. The other one is tax deferred. This is also a forever taxed bucket. And these are our 401ks and our IRAs. And then in the never taxed environment, you're only talking about 2 kinds of things: death benefits from insurance and loans from insurance companies. And so when Ed Slott says we need to move our money from the forever taxed environment over to the non-taxed environment, that's what he's talking about. Moving it from taxable buckets into non-taxable buckets. And I make emphasis on this because a lot of times when we're talking to a financial advisor, we'll be trying to compare 2 scenarios, both of them that say make 5% or make 10% or make 15%. The problem is if you've got it 5% in a leaky bucket and 5% in a non-leaky bucket, they're not the same value. What makes a cash value accumulation contract so powerful? One, we can transfer our money from forever taxed environments like our savings and our investment funds, and we can move them into never taxed buckets. In other words, accumulation contracts. Inside of a cash value accumulation account, your money will continue earning interest and dividends without taxation or market risk. And that's one of the reasons why an accumulation account is so powerful. But it's even better than that. Once you have your account established, you can borrow up to about 95% of the value in that account, or your private equity, right? But you use it only as security or collateral. You're not withdrawing it, right? So without reducing the balance or your earning power. Think about that. Now, I said that to a friend the other day, and he was like, wait a minute, Eric, that's just too difficult to understand. That's too opaque. And this guy wasn't stupid. The guy makes about 40 grand a month. He's got 2 businesses that bring him good money. So he's not dumb, but he didn't understand that concept. And so he asked me to make it easier. And so I thought about it a second, and I said, all right, look, there are 3 functions of money. There is the banking or warehousing or saving of money. That's one function. And then the next one is the investment side of money, where we use our money to get a better ROI, right? And then there's the spending side of money. Well, here's what gets people sometimes confused. Obviously, on the savings side, we want our money to increase when it's in a savings account. We also want it to be safe and secure, and we want it to be free from market risk. Whereas in the investment side, we have the same goal of increasing the value, although we probably want to have a larger increase in value or a larger return on our investment, right? And so to do that, we expose our money to market risk, more return, that kind of a thought process, right? Well, the other one, obviously spending, this is where we want to increase our lifestyle or maintain our lifestyle. And those are the 3 functions. And where we're going to be dealing with today is just that one right there. Banking and savings side of it, okay? We're not discussing the investment side. And the problem we run into is that sometimes, because of market volatility, our savings account will provide us with better returns than our investment accounts. And so we get confused, or at least the market seems to get confused at times when people talk about accumulation contracts, and they think that they're an investment. And I really don't look at them as an investment. And again, this is just my own definition, but for me, an investment is exposed to market risk, all right? And a savings account is not exposed to market risk, regardless of how much money I make in either one of those. So I said to my friend, let's think of a cash value accumulation account as a savings account on steroids. This is a place where you can continue to earn interest and dividends without taxation or market risk, while at the same time you can borrow funds from the legal reserve insurance company, right, without dipping into or withdrawing your private equity. Where else can you find that kind of tool? So in a word, we're talking about arbitrage. Now, Diane helped me do the editing of this PowerPoint presentation. And when I got to that word, she said, you just got through telling them that you wanted to make it simpler or easy. And now you're throwing out a word that a lot of people don't understand. So let me just read you the definition. Arbitrage is the simultaneous saving and borrowing of currency in 2 separate accounts to take advantage of different interest rates with the same asset. And what is that asset? That asset is your cash value accumulation account. And because it is a cash value accumulation contract, in that contract, it is going to stipulate what your interest rate will be for the duration of that contract. In mine, until I'm 120 years old, right? So you get a contract that tells you how much you will be paid anytime you put money into that contract, that accumulation contract. And it stipulates what the interest rate is. On one of my accounts, my interest rate is 4%, okay? But I have another account I can borrow from, and again, because it is a contract, I get a contractual rate, again, for the rest of my life until I'm 121 years old, that I will pay when I borrow. And in my case, that's 4.76. So if you do the simple math, you take out the two fours, I can borrow money at 0.76. I can borrow money at less than 1%. Where can you do that? That is what is arbitrage. And that's what makes this so powerful, right? So this is a pretty simple concept for a loan officer to grasp. So let me kind of walk through this. Let's say I've got $50,000 in my accumulation account, right? And I've got that contract, that's my collateral, and it's going to continue to go up. And I chose 5%. I know I just told you my numbers were 4. I'm going to use 5 and 5 in this example just to keep it generic. But in mine, it's I can, as I said, I get an interest rate of 4 and I can borrow at 4.76. But again, every legal reserve contract would be different depending on the company you're with. So if I wanted to borrow money, in my example I'm going to use here, I'm going to say that I'm borrowing money at 5%, right? And let's say I wanted to buy a car, so I'm going to amortize this over 5 years. Okay, here's how this works. My accumulation account is out there and it is earning 5% on $50,000 over 5 years. That means that in the first year, my account will have grown to 52,000, then 55, then 57, then 60, and then 63, right? So I will have made over 5 years in interest $13,814. Simple to understand. Now, I wanted to buy a car, and let's say I went and borrowed $50,000 from the legal reserve insurance company. Remember, I don't take this out of my account. My cash accumulation account continues to grow at, in this example, 5%. With mine, it's 4, right? So I borrow that 50,000, and the first year I've paid down to 43, and the next year I paid down to 33, and the next year I paid down to 24,000. The next year after that, 13,000, and then finally the 5th year I pay it all off, right? So during that 5-year span of time, I will have paid the legal reserve insurance company $6,614. So if we take the $13,800 I made and the $6,600 I had to pay, I end up with $7,200 positive cash flow or arbitrage. And that's what makes this so powerful.